Hi everybody, it's Tom Sheridan and Chris Darbyshire, right out of the Q3 Asset Allocation Committee meeting for 7 a.m. The committee had three major issues that they wanted us to focus on: quantitative easing, China, and the United States. Chris, QE, what was the thought?
The problem with QE is trying to understand whether other investors think it's going to be a problem. And the market seems to have gotten worried that if the pace of QE slows significantly, that could reduce asset prices and perhaps even slow down the recovery in the US.
And QE is not a one-size-fits-all phenomenon right now. So we've got the UK is one set of facts, Europe is another, China is another, Japan is another, the US is another. Give us a very quick rundown of which way the arrows are pointing.
That's right. The UK is really flat at the moment, is not significantly using QE. Europe is actually in a tightening phase at the moment, where the amount of the monetary base in Europe is declining as banks repay their loans to the ECB. The US is still actually one of the bigger easers at the moment. Despite the talk of QE tapering, it's still putting a lot of money into the economy every month.
$85 billion a month?
Indeed. And Japan has just suddenly begun to do a similar amount of QE. So you've got the US and Japan that are big stimulators at the moment, whereas the UK, Europe, and actually China now are beginning to tighten their QE programs.
So after 6 years of throwing the kitchen sink into the economies, central banks are generally telling us at some point in time it has to end, and markets didn't like it for a while, but our view is that actually had to come, huh?
It has to come. You can't keep pumping $85 billion a month into assets, and I think investors are just going to have to get used to it. After all, the reason QE is ending is a positive.
Yes.
It's that the economy is strong, and QE has done its job of getting the economy to a point where it can get back on track under its own steam.
So markets wobbled, but QE wasn't the whole story. China. What's the China issue in the market?
China has recently become more of a concern for the market, and we think is now the main concern for the market. The Chinese government is trying to engineer some kind of slowdown in the pace of development in China, some kind of rebalancing of the economy away from a more investment-reliant economy to a consumption-driven economy. These changes are not going to be easy, and at the same time the government in China has to deal with a lot of non-performing loans at regional banks.
So we've got the new regime come in over the last year in China, and if they're looking at a 10-year tenure, they're very likely to want to clean the house early in their stay in government. Is that what we're seeing?
Not unlike the CEO of a corporation getting the new job, you tend to kitchen sink all the bad problems into the market early on, and once that is in the market, you then got a clean slate to push ahead. So the new party committee has got a different approach. It's somewhat less it's less in favour of development and economic growth, and it's more in favour of steady growth, ecologically responsible growth, and dealing with some of the problems out there, such as the non-performing loans at the banks.
We've seen what happens in the States when you burst a credit bubble. It can get pretty ugly. Is this a Lehman moment for China?
So I think that's what the market's worried about. As I said, we've seen interbank rates up into double-digit figures recently, and that was eerily reminiscent of Lehman's. But it's a command economy, and it's really a command market as well. And
what do you mean by a command market?
A command market is one where the government, or the party in this case, and the central bank really controls the market and can send it in any direction they want to. It's not easy engineering any kind of slowdown. And there are excesses in China. A lot of unproductive investments have taken place. So that's the market's worry. The market's worry that it really is going to be hard and will come with some very nasty road bumps along the way.
So very possibly better they do it now than they wait to do it later then?
Better to get it on the table now and begin the process.
Now, the States is possibly a bright spot on the landscape. We've had a number of things that we've highlighted in our past asset allocation committee. We talked about shale the last time around. We talked about a little revival in the housing market. We've got possibly return of capital expenditure, an employment situation. Tell us, what's the focus of the committee?
So the focus of the committee is on shale oil and gas. And this is a real game changer for the US in the sense that it makes the US a much more competitive producer of products. So the US companies, for example, are paying $4 for a unit of gas, whereas European companies are paying $14 in equivalent terms.
Triple.
Indeed. And this is going to make the US manufacturers, where energy is a big input, much more competitive, and it really changes the global landscape a bit.
So does the U.S. have the ability to pick up the slack in global growth that China is going to leave behind if the tightening in China continues?
We really think it does. China's economy is growing, and its role is more to add to the amount of global growth every year. There is some, there's obviously a beneficial effect on developed market companies, but it's really relatively small compared to the amount of growth that the US can generate for those same companies, where their businesses are more established in US markets.
Okay. A lot of the feedback we've had from our viewers is a little bit less time on the macro view, and tell me what you're doing inside the portfolios, please. So let's leave the macro view at QE, China, and US being the major points. And some of the other points, such as emerging markets, we can pick up in terms of what we're planning to do in the portfolios. So let's focus on equities to begin with. What are we looking at with equities in the 7IM portfolios in the coming 3 months?
So in aggregate, we'll be at or slightly above our neutral allocation to equities. Yep. So we like equities. Within that, we're going to be using a tilt towards value companies, so companies with a lower valuation, lower price earnings multiples, and we're going to be tilting probably more towards small cap.
And how about geographically?
Geographically, we're going to rebuild an overweight position in Japan, currently neutral. We did well with our Japan allocation in the early part of the year. We've cut it subsequently, and that has proved to be a good decision. So we're going to rebuild that. We think the Japanese market has stabilized now. There's positive earnings growth to come from that region, and there's not that many good stories out there at the moment.
So valuations as a whole, after we've had the tremendous run-up and then the pullback, we're a little happier with valuations now?
Valuations in Japan are difficult to tell, actually, because the amount of earnings growth is going to be quite significant, but it's going to vary by sector. We think it's certainly not overvalued, though. We think it will be a fair value rather than cheap.
And you talked about taking a little bit of money out of Europe.
Yes, European markets have done well, actually, into this correction. They've done much better than the FTSE. But at the same time, earnings have declined in Europe more than in other regions. This has sent the valuation of Europe up. So the multiples in Europe are now up among the highest of the developed markets. So for us, that's a signal that it's time to cut back on Europe. And that money actually will go into emerging markets at some point.
Right. So emerging markets got absolutely caned over the last couple of months. Not only did the equity markets take a hit, but the currencies also took a hit. Fortunately, we didn't have a lot of our allocation in emerging markets. You're changing your view now?
Yes, we were significantly underweight. And every emerging market has been, as you say, hit pretty badly. And it's really not just about China. It's not sentiment deriving from fears around China. Each market has its own story to tell. And so we've had this sort of run of, bad events going on in emerging markets. It's sent the valuations right down. Earnings are holding up okay, actually. Earnings are ticking along quite nicely. So that makes emerging markets now, when we think that the bad news is really in there, quite an interesting prospect. Okay,
so quick recap. Level to a little bit overweight in equities, particularly going forward. Some of the cash that we've accumulated you may spend. You're likely to spend a bit of it in Europe, a bit of it out of Europe rather, a bit of it into emerging markets, and a bit into value.
Yes. The other area that we're looking at, which we think is interesting, is private equity.
Right.
And private equity you can access through listed companies like you can any other equity stock, or you can go in through closed-ended companies which are trading at significant discounts at the moment. We like private equity because we think there's a lot of bad news built into the prices there. Right. We think the NAVs are somewhat behind the times and should benefit from a reasonable run in stock markets from here, but in a leveraged way, so you get a bit more return for your allocation there.
So the NAVs are okay, plus there's a discount to the NAVs. So emerging market and private equity sounds like a fair bit of risk that you're willing to put on.
It's more liquidity risk than valuation risk.
Right.
So we're going to be rejigging the portfolios to avoid any unnecessary liquidity risk in other asset classes as well, so that the portfolio as a whole stays reasonably balanced.
Okay. One of the things that's gotten a lot of airtime recently with regard to equities, and particularly with regard to 7IM, who is very, very active in the passive markets, is smart passives or smart beta. A quick couple of words on what we're doing there.
Yes, so we're using smart passive investments to tilt our portfolio away from the more expensive defensive stocks, the high dividend yielders, the quality stocks is the term that is most commonly used, and we're tilting the portfolios towards the more industrially exposed companies that have had a hard time over the past few years, but whose earnings are beginning to tick up now.
Right. That's a long conversation, that one, and we won't go through all of smart beta now, but we'll probably put together another piece on smart beta alone. Chris, switching asset classes now away from equities to fixed interest. Fixed interest is one of those things that everybody all knows that you're not supposed to have any of in this environment. But actually, if you're going to put together a diversified portfolio the way 7IM does, you are going to have some. Having said that, we need to be very careful what kind of fixed income we have in the portfolios. Views?
Yes, so you're right, there's a lot of differentiation within fixed income asset classes. An asset class like gilts, for example, is fairly simple to deal with. We've moved half of our gilt portfolio, which is already underweight, into very short-term gilts, and we've reduced the duration on the remaining gilt portfolio itself from 9 to about 7.5 years.
Good.
In corporate bonds, we've done a similar thing where we think they are exposed in a similar way to gilts to a rise in yields, but don't offer much in the way of return. So those allocations are underweight, and also we've taken half of them and put them into shorter duration.
So in a balanced portfolio, about how much we're talking about?
So we're talking about 9% in total between global and sterling corporate bonds.
Right, so not so much.
No.
Okay. What else are we doing with the balance of the fixed income allocation?
So our high yield allocation is moving more into floating rate debt rather than fixed rate debt. Such things as leveraged loans, where we've had a good experience over the last couple of years, and you have reasonably good credit risk, but you're getting paid just a bit more for it than you would for, say, a corporate bond.
That worked very well during the volatile days in June, didn't it?
It did. It was held its own very well, was almost flat, in fact, over the last month or so.
What else can we do? Emerging market bonds.
Emerging market bonds got hit very badly during the recent correction, and prompted partly by fears in China. And we've cut back. We cut back early on. The market has since fallen further for emerging market bonds, and now we're looking to get back in at a reasonably sensible pace.
Not unlike the equity markets, then.
Indeed, it's a relatively high-risk part of the fixed income market. It's getting on up towards equity risk.
The vast amounts of QE have fostered all sorts of conversations about index-linked securities. What's the 7IM view on index-linked?
We have been underweight index-linked and continue to be underweight. We just don't think it offers particularly good value at the moment. We don't think inflation is a significant risk right now, and if it did become one, it would take some time to build in the system, so one will get plenty of early warning signals. So we've underweight UK linkers. We've tended to prefer Italian linkers, where you get a bit more yield for your investment.
Right. Speaking of Italy, Spanish and Italian debt, we had some in the portfolios. They too had a choppy June. Where are we now?
We are going to increase our allocations to Spanish and Italian debt, and we're going to replace our sovereign debt globally with more Italian and Spanish debt, mainly Italian, where we think the yields are very attractive, and the counterparty risk is really not that far away from being the ECB.
Okay. So there is a fair bit that we can do within the fixed income asset class without simply buying long-dated gilts and waiting for the inevitable to happen. Moving on now to alternatives. You've already talked about private equity and our position there. Back very early in the year, you completely wiped out our gold position. You don't like commodities very much. What's left? Property?
Yes, property. We've held our position in property. It's not fared particularly well. The rise in interest rates has impacted our property holdings, but we like them. We like the asset class and feel that there's now really pretty good upside from here. So property stays as is.
So that's commercial property in the UK?
No, we have no UK exposure, very little UK exposure. It's all global commercial property.
So that's the equity picture, the fixed income picture, alternatives, and we still don't like commodities very much. When it comes to the currencies and cash, what's our position in those two?
Well, we don't like sterling as a currency. We think there's a few events out there in the next few years that could really seriously weaken sterling. We like the dollar. We think the US economy is a couple of years ahead of the UK. Yep. And although the UK is beginning to show signs of growth, the US is really on a much stronger trajectory.
Good. Okay, so that's a lot of material inside of one short little quarter. It looked like the entire world changed for the worse and possibly looking at an oh my God scenario in China, and as it turns out, maybe not. So overall, we are a fairly risk-on position, possibly looking for a bit more of that. Is that a fair way to summarize?
We're risk-off right now, looking to move risk-on.
Okay. Chris, thank you very, very much. And for those of you who would like to see the actual portfolios, they're available on the 7IM website or a number of microsites that we have around the market. Thank you very much.